All right, YouTube fam, volatility is back. On my channel, I've often said that during times of market calm, I would produce content that is educational so that you could build your skill sets. And that's exactly what we've been doing in the last several weeks. And when volatility is back, like it is now, I would put on my analyst hat and help you stay level-headed and understand what's coming up next. Today's video is on the US macroeconomic situation and an important update on the Chinese internet equities sector, a very large source of tension right now since this sector is once again on the verge of testing a long-term support area. And along the way, I will provide my usual macroeconomics coverage along with analysis, so take good notes. Oh, and in case you're wondering, yes, I still am in Chinese equities, and my taxable accounts are split roughly 30-70 China-US. My top positions are still holding up relatively well, but my Chinese internet positions have retraced significantly. So if it helps you sleep better at night, do know that your favorite investment strategist is riding this journey with you. And as a reminder, as we move towards a more dangerous investing environment, like I said in my YouTube community tab, proceed with caution, do good research, buy slowly over time, and discard the thinking that cash is trash, because dry powder is always helpful. Now, I know that many of you have told me that you enjoy my macro and fundamentals analysis content, so let's dive deep and understand what's likely coming up next for US and Chinese equities. But if you're new, the subscribe button and bell will enhance your critical thinking, so make sure to join my YouTube community to learn the insights that you need to survive in this market. Throughout the video, I'm going to reassure you with my analysis that we're going through some volatility, yes, but as of the recording date of this video, I strongly do not believe that the bull market has officially ended. So here is the game plan for today. Two major areas. Feel free to re-watch certain areas if you need to. The first part of today's video is going to be an overview of the current macro situation and what that means for US tech stocks so that you're up to date with my insights. The second part of this video is a deep dive into the fundamental analysis of why Chinese tech is still struggling and provide an update on my revised expectations for when this sector and stocks like Alibaba and Tencent will rebound. So you ready? Let's do it. First up, the macro environment with a focus on the US. Since the last time I gave an update on my views on macro strategy, I do believe that the economic situation has become a little bit more complicated. The narrative of easy money is slowly starting to shift, and you need to be aware of this. Allow me to explain. I want to take a moment to give you a very quick summary of the Fed's November minutes. In their latest Fed minutes, Jay Powell and team have indicated that the current pace of tapering will conclude by mid-2022. But that was before his latest congressional testimony about possibly making the tapering process faster. Now, this Fed policy now needs to be considered in the context of weakening consumer confidence and the potential risk that they could bring the US economy into stagflation if their efforts don't actually tame inflation. Now, we can see here in this table I created for you, the tapering process timeline will look like this. With Treasury bond purchases to be reduced by $10 billion each month and mortgage-backed securities by $5 billion each month. And at this pace, assuming no changes each month, QE will end by June 2022. Now, this means that the clock has started to tick on ending the era of easy money, which means we've got 6 months of QE left. And if we take a look at the M2 money supply, which has a very strong correlation to the S&P 500, you will see that if we extrapolate a taper off in the M2, the S&P 500 will also likely enter a phase of consolidation and heightened volatility. Now, in his latest congressional testimony, Jay Powell even said that due to inflationary pressures, it might be appropriate to speed up the tapering process. So the table that I just showed you, be prepared for revisions in their upcoming December meeting on the 14th and the 15th. Now, this meeting is 2 weeks away, and the market is going to factor how the new COVID variant Omicron will change the Fed's decision-making calculus. Now, here's why I think Jay Powell intends to continue tapering despite the new COVID variant. Now, COVID has the power to once again slow down the supply chain process, which, as you know, can cause bottlenecks, and it can distort transportation logistics. Now, shipping experts are once again expecting the index of shipping costs from China to the US West Coast to push freight rates once again back to record highs. And we're starting to see these freight rates once again tick up, which means that transportation costs within our economy are increasing again. And while shipping companies such as China's Costco benefit, it hurts importers that have to bear these costs, which are once again passed on to consumers. And this will show up in our CPI readings in the upcoming months. Now, I think that the market is at an important juncture, but the real test comes on the December 14th and 15th meeting when the Fed communicates to the market their plans for tapering. Now, the concern is that tightening needs to be done at precisely the right time. If not, it might not end up taming inflation, and the Fed will go on a much more aggressive hiking cycle. This will produce the stagflationary environment that several notable economists are calling for, where we are in a period of high inflation but weak economic growth. Now, the key takeaway is this: the December 14th and 15th conference will give us clues as to what's coming up next. Until then, we will see trading volatility, but no side has a clear advantage. Bull markets don't usually end on the anticipation of interest rates, only after they have been put in place. Now, up next, I want to do a deep dive update on Chinese tech equities. To tell you up front, my research does suggest to me to push back my own expectations for a sustained Chinese internet equities rally for at least 1 to 2 more quarters. Now, let me show you my thought process behind why I think Chinese internet stocks will definitely recover, but that timeline may not be immediate. Let me start off with macro. A couple weeks ago on my YouTube community tab, I classified the US-China meeting between Biden and Xi as quote-unquote good enough. Since then, we've seen US Marine warships sailing through the Taiwan Strait, and in response, China's mouthpiece, Global Times, calls out that provocation as straining the relationship further. It seems that the meeting between Biden and Xi actually did not provide constructive plans to get the relationship back on track and might be a little bit more lip service. So in my opinion, it seems that we're back to square one on the geopolitics front, 1 step forward, 2 steps back. Now, also weighing on sentiment is the fact that China's GDP in the third quarter grew at 4.9%, which is impressive, but it was slightly below the 5.2% consensus that the street was expecting. Now, keep in mind, this growth rate is still very impressive in the context of the current macroeconomic environment, and there's still definitely the possibility that the full year GDP beats expectations, but like I just mentioned, we would have to wait for the next quarter to see that play out. Now, for the fundamentals analysis perspective, we're going to take a look at where Chinese tech stocks, especially the internet sector, which contains Alibaba and Tencent, stand through a deep fundamental dive on the KWEB index. So let's take a look at why this sector is struggling in the past month. And from this, we will start to see when big names like Alibaba and Tencent could be revived. First of all, I want to help you understand the big picture. The largest Chinese ETF by fund flows is the KWEB ETF. It has a total of approximately 8.7 billion in assets under management. Now, if we want to know the direction of the Chinese internet sector, then we need to understand very carefully the top 10 positions inside KWEB. I would even suggest that you put KWEB in your watch list. Now, in this table below, which I have constructed for you, I have listed the top 10 positions within the KWEB index by weight, along with columns that contain my opinions on their fundamental and technical direction. Now, keep in mind, and I will say this again, My classification of their fundamental and technical direction is my opinion. To make it as objective as possible, though, I classify fundamental direction as of what I have observed so far from these companies' latest earnings report and their guidance. For their technical direction, I think it's fair to use the 100-day EMA to objectively say whether the stock is in an uptrend or a downtrend if you're a long-term investor. Now, I'm going to spend the next several minutes helping you digest and understand the state of the KWEB index. And after these next several minutes, you'll have a much better handle on what's happening and look at the recent price actions from the perspective of an analyst and not simply a retail investor. Okay, when we take a look at this table, you'll see that within the KWEB ETF, I have listed the top 10 positions by weight, and a closer inspection will reveal that the fundamental direction of its top 10 companies is mixed, while most of the top 10 companies' technical direction is down. Soak that in for a moment. In my mind, this spells opportunity for long-term investors because the share price always catches up with fundamentals. The million-dollar question is, how much longer do we have to wait? In order for the Chinese internet sector to turn around, I firmly believe that we need at least 7 or 8 out of the top 10 positions within the KWEB index to showcase very strong fundamentals and at least slow the trajectory of technical declines. In order for the narrative to change, we need major players within the index demonstrating strong fundamental growth. This will, at the minimum, take several quarters to play out. We have to think of this sector's future as a great balancing act. The ability to continue playing the China growth story while keeping up to date with the latest regulations. Now, in this table that I have constructed for you, you will see the top 10 companies within the KWEB index, from Tencent all the way down to Bilibili. I have 2 very important columns for you to note. Feel free to pause this video and take good notes because they include my observations from the latest earnings report according to my research, and also subjectively when I think that the stock will recover. Now I'm going to give an overview of every company in the top 10 so that you understand why I believe that a recovery is coming, but that patience is required. So you can see in this research table, which took me a long time to put together so that you can use for your benefit, you can see that in the first column, I've listed the top 10 companies within the index from Tencent all the way to Bilibili. The second column includes the weight. The most important detail is in the third column, where I combed through every single company's earnings transcript and noted what might be the catalysts that can take this company forward in the coming quarters. So starting off with Tencent, President Martin Lau believes that regulation will be more incremental over time and that the company expects the impact to be smaller going forward. So in my mind, that means that within the next 1 to 2 quarters, I do believe that Tencent will most likely put in a long-term bottom if it hasn't already. Now for JD, which we know is already on an uptrend again, JD's CFO, Sandy Xu, believes that long-term gross margins will steadily increase despite macroeconomic uncertainty. This explains why JD's stock is already recovering faster than its peers. Now up next, the third largest company in the KWEB is Meituan. And this company is very important to the index because it measures consumer sentiment in China. Now, CEO Wang Xing noted that COVID restrictions have slowed delivery order volume. So in my mind, according to their earnings transcript, this company will take 2 to 3 quarters in order to recover. But because it's the third largest weight in the index, that means that there is going to be some drag on the sector. Now, up next for Alibaba. In their latest earnings, CFO Maggie Wu says that China's GDP and consumption slowdown is being reflected in their 2022 outlook. In my opinion, this means that Alibaba will be going through a multi-month consolidation phase to set in that long-term bottom. In my opinion, this could take as long as 2 to 3 quarters before the stock price experiences a significant rally. Then we have Pinduoduo. at 6.3% of the index. Now, when asked by the sell-side analysts whether Pinduoduo was pursuing profitability over growth in 2022, CEO Chen Lei and the VP of Finance said that they are heavily investing in research and development dollars and user experience, and that profitability is not one of their key performance indicators, their KPI. So in my mind, that means that once again, we're going to have to be patient with Pinduoduo, because if they're not focusing on profitability, shareholders will not see the immediate benefits of their investment cycle. Then we have Netease, and Netease is doing really well within the index, and it's because they had a recent big blockbuster called Narake Blade Point, and it's now one of the top selling games ever on the Steam platform, and it took revenue to record highs, and it's already on an uptrend again, the stock. Problem is, Netease is only 5.8% of the index, so even though it's enjoying tailwinds, this company alone is not able to shape the direction of the overall sector. And then up next, we've got Trip Group, which, by the way, in case you're not familiar with it, is somewhat like Expedia and somewhat like Booking.com. Now, this company, CEO Jane Sun said that domestic travel within China offsets weakness from international travel. And because Omicron has once again resurfaced, we have to give this company at least 2 to 3 quarters for it to, flesh out its potential. Now, up next, we've got Baidu. And for Baidu, CFO Herman Yu believes that regulation is impacting ad spend across education, real estate, and home furnishing, and COVID has impacted travel ad spend as well. And because of this, they believe that weak ad spend could be a multi-quarter story. So from my opinion, I believe that Baidu will also take 2 to 3 quarters to recover. Now up next, we've got Full Truck. And Full Truck is a logistics and transportation business in China. And for them, according to their latest transcript, current headwinds caused by China's power shortage won't impact long-term growth, but it will take several quarters for the company's business model to recover. And finally, we've got Bilibili, a company that I personally really like. However, in the latest quarter, they potentially will be pursuing share issuance in order to build out their content platform for the future. And so for that reason, with share issuance and also the dynamic of just meeting investor expectations, we're going to have to be especially patient with this one. So I believe within the next several months, Bilibili will most likely be range bound, and their recovery will probably be at least in the second half of 2022. Now, from my table of the top 10 Chinese internet stocks within the KWEB, I believe that it'll take several quarters for the market to digest the regulation fears, for the Chinese economy to recover from its recent GDP miss, and for consumer consumption to recover. So you can see that nearly every single company in this top 10 table is facing headwinds, with the exception of JD and Netease. But these two companies alone can't turn around the entire KWEB index and the market narrative. And like I said, given that most retail investors only know about Tencent and Alibaba, this bottoming process has to include Alibaba. I don't believe that sentiment surrounding China will change until Alibaba recovers. But from their latest earnings report, Alibaba's results are being impacted by China's current economic environment. Now, Wall Street analysts are cutting Alibaba's estimates, which should make beating future expectations easier. But structurally speaking, Alibaba, just like Pinduoduo, is entering a heavy investment cycle of allocating capital towards R&D. And Wall Street is starting to believe that Alibaba may have their investment cycle to last until fiscal year 2023. So for the foreseeable future, this results in lower EPS and therefore profitability. In the long term, this means Alibaba's business model will be stronger and that the share price could indeed be at least a double from here. Most companies that do substantial R&D eventually see large payoffs because their moat becomes stronger, but my conviction is that Alibaba is going to need at least 1 year to pull this off. So if you are invested in Alibaba, you have to have the patience at the Warren Buffett level or the Charlie Munger level. The reason they're such good investors is that not only are they analytical, but they're just more patient than 99% of investors. They essentially outlasted the market with their patience. And I think that's the game that is being played right now in Chinese internet. Those who make significant profits in this sector aren't necessarily smarter than you, they simply outweighted you, they outlasted you. So combining through the earnings reports of each of these companies tells me that we could still be 2 or 3 quarters away from a bottom in the fundamentals. So with this in mind, I would suggest dollar cost averaging in smaller chunks to get your allocation in the sector if you're interested in Chinese equities, rather than buying in lump sums, because it's clear to me that this is not going to be an overnight turnaround story. So we will see Chinese tech at much higher prices over a longer period of time. My research definitely supports that, but over the short term, we're probably in the process of a multi-month high volatility consolidation phase. Now, I believe in China's growth story, and within 5 to 10 years, I'm sure that I will be rewarded, but the key word here is that this is a multi-year trade and not an investment that should be looked at year by year. If you enjoyed this kind of analysis, then join my YouTube family by subscribing and turning on that bell and leaving your email in my form below if you want to stay updated with my channel. This is the kind of research that I will share in my future private investment community coming in January 2022. Be the first to know if you put your email in my form. Now, I also really wanted to thank you for helping me grow on YouTube. The more powerful you make my channel, the more my insights reach wonderful people just like yourself. So join me, be a part of what I do. And as always, I wish you good luck in your trading and in your long-term investing. And my friends, I will see you in my next video.